Goputta, shall we start the session? This is depreciation allowances and balancing allowance. This is part 2 of the business income. Part 1 is sent to you through one other recording. So we'll discuss about the depreciation allowances and balancing allowance. Depreciation allowances and balancing allowance. Since all of you have learned this accounting, how to provide depreciation, how to work out depreciation on the assets and so on, this topic is quite familiar to you all. Not that difficult since you have learned this. In the accounting standards, you have mastered this. For the tax purpose, many of the things are common, except tax sometimes tax law supersedes the accounting standards. Tax law supersedes the accounting standards in the sense, all the assets are to be depreciated in a straight line basis as per the Inland Revenue Act. But since you have learned accounting, some of the assets could be depreciated using any other basis which reflect the consumption or usage of this asset for that particular entity. But as far as the tax law is concerned, the life is quite simple. We have to use just the tax law. So we'll go ahead. This is depreciation allowance and balancing allowance. Depreciation allowance, simply as per the tax law, how much is the depreciation charge? Or some other technical word is capital allowance. The balancing allowance is, sometimes, depreciable assets are loss, sold on loss. When those assets are sold on loss, there are tax losses. Those are referred to as balancing allowances. Balancing. So as per the tax law, depreciation allowances and balancing allowances are allowed to be deducted in calculating person's income from business. So if you are provided with the net profit of a particular entity, either an individual or a company or business, so you are provided the financial statement, there you can pick up the net profit. That net profit is arrived at after charging accounting depreciation. So the basic thing you should remember is all this accounting depreciation are to be reversed. It has to be added back, and you can only deduct the depreciation calculated as per the Inland Revenue Act. It could be deducted. Accounting depreciation is added and deduct the depreciation allowances as per the Inland Revenue Act. So we keep on going. Depreciation allowances are granted in respect of depreciable assets, not in respect of all the assets. Depreciable assets, in accounting, normally lands are not depreciated. Land is not a depreciable asset. So is the case for this tax purposes. Depreciation allowances are granted in respect of depreciable assets. Not only that, this depreciable asset should be owned and used by a person. Owned and used by a person. It has to be owned and used at the end of the year of assessment in the production of person's income from business, calculated in accordance with the provisions of the second or fourth schedule to the Act. One thing you should remember is sometimes, on the 31st, say, let's assume, somewhere around March of a particular year, an organization acquired a lorry. Let's say date is something like, say, on 20th March of a particular year, a lorry is acquired or purchased. Even though the lorry is purchased, some requirements are to be done before allowing the lorry to run on the road. So it has to be registered in the name of the company. Revenue license are to be obtained. This fuel emission test to be conducted. So these things are to be done. So if this cannot be done by 31st March of this year, this lorry cannot be used in this year of assessment. It is owned during the current year of assessment. It is not used. So it is used in the next year of assessment. As far as this lorry is concerned, in respect to this lorry, for the current year, depreciation cannot be claimed. Depreciation can be claimed starting from the next year onwards. That is the meaning of this owned and used by a person at the end of year of assessment, in which the production of the person's income from a business. So that is the case. So we'll go to the next one. Say, remember, own and use, that is quite important. We'll go to the next one. So depreciation, same thing continue. Depreciable asset is defined as per the act. Say, this is this is known to you. But as per the internet, an asset to the extent to which it is employed in the production of income, employed in say used in the production of income from a business, and which is likely to lose value because of wear and tear. Likely to lose value, value will come down since we are using it. Even though we do not use, the assets will get obsolete, outdated. It is subject to wear and tear, subject to corrosion. So many things happens. At the time keeps on going, the value of the assets come down. So these are to be accounted for by the entity. But for these purposes, the depreciation assets also excludes goodwill. Exclude goodwill and interest in land. The goodwill is not depreciated. Goodwill is a collection of unidentifiable assets. Unidentifiable intangible assets. So that is not depreciated. And interest in land in the sense, say simply a land. We have a land, therefore we have an interest in the land. A membership interest in an entity and trading stock. Membership interest in an entity. Say, let's say we are a company. We have taken some shares of some other company. So we have membership interest of some other company, but that is not a depreciable asset. And trading stock. Trading stocks are not depreciable assets. For example, let's say normally all the vehicles for a manufacturing company, vehicles are depreciable assets. But let's say there's a company whose business is to buy and sell vehicles. Buy and sell vehicles. Therefore, their trading stock is vehicles. That is not a depreciable asset. Not a depreciable asset. Accordingly, following conditions has to be considered. The conditions to be satisfied in respect to the depreciable assets when claiming depreciation allowances. When claiming capital allowances, following conditions are to be adhered to. Following conditions are to be adhered. The ownership of the assets should be available to the relevant person. Relevant person in the sense, as per that, may be an individual or a business entity. Ownership. Legal ownership or ownership of the asset in any other way as specified in the asset. One thing is legal ownership. Ownership of the asset in any other way. Maybe the legal ownership is not there, but there's a contract to use this asset for a particular period of time. If that is the case, that is considered as the ownership of the asset. Next one is a lessee has the ownership of asset obtained on finance lease. Finance lease. Not operating lease, remember. A lessee. Lessee has the ownership of assets obtained on finance lease. Used by the person for production of income. Used by the person. It has to be used. It has to be used by the person. If any depreciable asset is entitled for a deduction of depreciation allowance, then such claimable one cannot be deferred for future period. Let's say we purchase a lorry. For tax purposes, we have to start providing depreciation from this year of itself. So we can't defer the depreciation allowance to some other years. For example, a lorry, we purchase and use a lorry during the current year. The life is 5 years. If we do not claim the depreciation of this lorry for the current year due to some reason, in the next 4 years, we can claim the depreciation in respect of those 4 years. So we can't defer. We cannot postpone. That is the meaning of deferring. We have to provide the depreciation in the current year. The depreciation allowance, say very easy, the straight line method and following formula should be used. Depreciation allowance equal cost divided by number of years relevant to each depreciable asset. Number of years relevant to each depreciable asset. Cost divided by number of years relevant to each depreciable asset. This is simply the useful lifetime of the asset. Full depreciation allowance will be granted for the year of acquisition or year of purchase if such depreciation asset used up to the end of the year of assessment. If a particular asset is acquired on, let's say, 20th March of the current year, very few days are remaining for the current year. If we have purchased and used during the current year, it's okay. We have used the asset for a, very 30, if 20th March, 31st March on 11 days. But as far as the tax law is concerned, the full year's depreciation not to be provided. It could be claimed. And in the year of disposal, no depreciation allowance will be granted for the year of disposal. But the reason is, at the end of the year, the person does not own this asset. No depreciation allowance will be granted for the year of disposal as such asset is not exist in the hands of the person. If we conduct a business, if we sold an asset during the year, at the end of the year of assessment, we do not have this asset in our hand. Therefore, in the year of disposal, no depreciation allowance will be granted. In the year, say, to summarize, in the year of acquisition, irrespective of the number of months or number of days in which we use this particular asset in our business, irrespective of those days, provide depreciation for the full year. Similarly, in the year of disposal, no depreciation allowance could be claimed. The reason is, at the end of the year, we do not have that particular person, do not have that asset in their possession. It has been disposed. So we'll go to the next one. Depreciation allowance. Say no depreciation is allowed on road vehicles. All the vehicles are run on the road. Not all the vehicles, we have helicopters, airbuses, and submarines. All are vehicles. No depreciation allowed on road vehicles. Road vehicle. What is the road vehicle as per this act? Road vehicle does not include the following. This simply on road vehicle depreciation cannot be claimed. So what are the road vehicles? A commercial vehicle. Say road vehicles does not include the following. Does not include. So these things are not road vehicles. These are not road vehicles. All the other vehicles are road vehicles. Say a bus or minibus is not a road vehicle. Therefore, depreciation could be claimed. A goods vehicle, a lorry, which is used to transport, goods or commodities, it's not a road vehicle. Therefore, depreciation could be claimed. A heavy general purpose or specialized tractor, trailer, backhoe, something like that. Those are not road vehicles. Those are vehicles, but not road vehicles as per that. Simply, it's something like, transporting of persons from somewhere to other place by the organization. Those are referred to as road vehicles. All the other vehicles, we can claim depreciation. The first one, a commercial vehicle. Commercial vehicle means a road vehicle designated to carry loads of more than 13 persons. If the seating capacity is more than 13, such vehicles are not road vehicles. Therefore, depreciation could be claimed. Or vehicles used in transportation of vehicles rental businesses. Vehicle rental business. Let's say we have vehicle rental business. Our business is to rent vehicles, not to sell vehicles. Therefore, these vehicles, let's say we have cars. We give our cars to tourists or some other persons. That some other person will use this vehicle for transportation. But for our business, we can claim the depreciation. Say, how about the vans? Say, let's say there is a van. In front, there are 2 seats. In the back, there are 3 seating capacity. Altogether, including driver, maybe 6 seating capacity. Is that road vehicle? Is that a road vehicle? That's the question. So, no, 13 passengers cannot be accommodated. So, if that is a road vehicle, depreciation cannot be claimed. If this particular van is given to an accountant or the FM or managing director for his usual traveling, that is referred to as a road vehicle. Therefore, depreciation cannot be claimed. But let's say the same van is given for delivery of goods or delivery of samples. If that is the case, that is not a road vehicle. Say the third one says a goods vehicle, a vehicle in which we transport goods, could be a van. So you'll have to see or check whether a particular item is a road vehicle. If that is a road vehicle, depreciation cannot be claimed. Simply for an organization, normal manufacturing organization, the cars will be used for transportation of the executives. So on such vehicles, depreciation cannot be claimed. For all other vehicles of that business, depreciation can be claimed. So we'll go to the next one. Balancing allowance. Balancing allowance. When a depreciable asset of a person is realized, how do we realize? We sell it. When a depreciable asset of a person is realized by the person before the end of the year of assessment, the balancing allowance is calculated as follows. Say asset is realized, which means asset is sold off. So the balancing allowance is calculated as follows. Balancing allowance is calculated as follows. Balancing allowance. So disposable profit or loss. Selling price minus tax written down value. Selling price minus tax written down value. In accounting, we know how to identify the disposal profit of the asset. Disposal profit of asset. Selling price minus accounting depreciation. Accounting written down value, carrying amount. So for the tax purpose, we have selling price minus tax written down value. Tax written down value. This written down value is calculated based on the tax laws. That is the only difference. This is referred to as a balancing allowances. This could be either profit or loss. If this is a loss, it could be deducted. If this is a profit, it has to be added back to the tax profit. So we'll go to one other interesting topic, repairs and improvement. Repairs and improvement under section 40. Say expenses for the repair or improvement of depreciable assets shall be deducted irrespective of whether they are of capital nature or not. So you'll have to clearly understand that says whether these are of capital nature or not. So we'll see improvement. The meaning of improvement is the expenditure incurred by a person to make additions or alteration to depreciable asset. So this particular item of expenditure should increase the value of the asset, the material part, but exclude the expenditure incurred to maintain or repair depreciable asset, which temporarily enhance the value of such asset. For example, let's say we have a factory, we color paint the factory, color was the factory. If that is the case, so that is a maintaining activity, not an improvement. But if we add one other section to the factory, we had foundation, thereafter walls are constructed, there's a particular roof, thereafter we intend to install some machines. That is an improvement. Therefore that is an improvement to the factory building. The improvement to the factory building. So let's say at the moment, say we have office building, that particular office building will have cement floor. So we thought of having carpets for our office, carpets, floor carpets. So that cannot be referred to as an improvement. That is a maintenance like. So if that is a maintenance or repair, it could be directly charged to profit or loss. So this refers to improvement. Refers to improvement. So improvement cost need to be deducted subject to the following limits. The improvement cost, say all the repairs could be deducted. All the repairs could be deducted. All the repairs could be deducted. Say improvement, all the improvement amounts cannot be deducted. You will have to check some conditions. These are the conditions. Say improvement cost need to deduct subject to the following limits. The building 5%. Other depreciable asset 20%. What is this 5% and 20%? For the buildings and similar structures or whatever fittings permanently fixed to the building. So all the buildings 5%. Other depreciable asset 20%. Say this 5% or 20% is computed written down value of the asset at the end of the previous year. Say we have to refer to the last year written down value, apply 5%. That value, after applying 5%, we get the value. So we compare that 5% value with the improvement cost. Thereafter, we can decide how much is to be capitalized, deduct. How much is to be deducted. The excess improvement expenses for which a deduction shall not be allowed. For example, let's say our improvement cost is 100,000. 100,000. So we check whether we can deduct this improvement 100,000. So based on this formula, say for that other depreciable asset, we get 20%. Last year written down value of a particular asset, we get 20%. That 20% came to, let's say 60,000. This 60,000 could be deducted as an improvement. Just deduct, treat as an expense. So how much is not deducted? Not deducted is 40,000. That 40,000 is added to the depreciable base of that particular asset. So there is an example. We'll work out such examples with you. So this next one, depreciation rates, very easy to remember. Very easy to remember. Say why very easy? Say buildings, structures, and similar works of a permanent nature 20%. 20%. not 20%, sorry, that is 20 years, 20 years, 20 years, over 20 years. As a percentage, that is 5%. As a percentage, 5%. For all the assets, the value is 5 years. Over the 5 years, we have to depreciate. What are all the other assets? One is computers, data handling equipment together with peripheral devices. What are peripheral devices? Let's say peripheral devices. Say servers are peripheral devices. Laptops are peripheral devices. All the other gadgetics or printers, let's say, or scanners, or whatever the gadgets that are related to these computers and IT, all these things are fine. The next one, the vehicles, buses and minibuses, goods vehicles, construction or earth moving equipment, heavy general purpose or specialized trucks, trailers and trailer mounted containers, You would have observed that uh, for the trailers, there is a different registration number. So company could have one vehicle and couple of trailers. So for each trailer, those are vehicles like the plant and machinery used in manufacturing. Everything is 5 years. The railroad cars, locomotives and equipment, something like railway engines, vessels, barges, tugs, and similar water vessels, vessels, barges, tugs, all the railroad cars, water related, transportation equipment, aircraft, specialized public utility transport equipment, machinery, office furniture, all the things. Furniture, say, very easy to remember. All the things are fine except the buildings. See, there are some exceptions. Intangible assets excluding goodwill. Goodwill is not a depreciable asset. For the accounting also, goodwill is not, it. Goodwill is accounted separately. Goodwill is not depreciated. In the tax law also, goodwill is not depreciated. The intangible assets, the actual life of the intangible assets, or where the intangible asset has an indefinite useful life, 20 years. For example, let's say a government give a particular license. Uh, the license does not say a particular time limit. So that is, the lifetime is indefinite. In that situation, we have to depreciate these intangible assets over 20 years. If the license is given for 5 years, over 5 years we had depreciate. If the license is given for 3 years, over 3 years we had depreciate. So that is the case. The other one, milking machines with latest technology used to manufacture local liquid milk related product with effect from 1st April 2021, 2 years. Milking machines. So these are more related to this agricultural business, farming business. Very easy to remember. Say, other than the goodwill, and also for the buildings 20 years, all the other items 5 years, milking machines 2 years. For the intangible assets, if the lifetime is there, we take that lifetime, otherwise 20 years. Next one, say number of years applicable to relevant calculate allowable depreciation before 1st April 2018. We have provided this table for the completion purposes, but this is still relevant for qualified buildings constructed 10%. A building would have been constructed before 2018, still it is coming. 10 years are, completed by 2028. So it's still this rate is there. Any intangible assets other than goodwill 10%. So this could be still there. Other rates, those are over 3. This is 3 years, 5 years, 4 years, those are over. So you'll have to remember for the buildings that has been acquired before 1st April 2018, that is 10%. And any intangible assets acquired before 1st April 2018, 10%. This, the yellow colored one, still relevant. Repairs and improvement. We continue on repair. In the case of written down value is 0. If the written down value is 0 for a depreciable asset, say improvement, when we identify the amount of improvement to be deducted, we have to refer to the written down value of the previous year. In the previous year, if there is no written down value, for example, we acquired the vehicle. The lifetime is 5 years. Therefore, over 5 years, we do the depreciation. On the 6th year, we undertake an improvement. On the 6th year, we have to see whether this improvement could be deducted or not. If that is the case, we have to refer back to the last year written down value. Last year written down value is 0. If that is the case, for any asset, you have to refer to this one. In case of the written down value of 0 for a depreciable asset, deduction of improvement limits to below. Improvement cost need to deduct subject to the following limit. Buildings within equal 12 years. Other depreciable assets within equal 3 years. In the sense, for the tax purposes, if we have claimed the depreciation for all the years, the 5 years, let's say, on the 6th year, if we undertake an improvement, so we don't have a written down value of the last year. In that situation, we have to claim this improvement in this way. For a building, we divide the improvement by 12 years and start claiming. For other assets, divide the improvement by 3 years and start claiming. Next one, simple activity. A retail goods transport company acquired a lorry for transporting goods on 22nd September 2022 at a cost of 4 million. The lorry can be used for 5 years. So this is in which year of assessment? Year of assessment 22-23. It has been purchased. So starting from that year, depreciation could be claimed. There are two requirements: allowable depreciation and the depreciation basis. So we'll work out. This is the answer. The very first year is 22-23. Depreciation base is 4 million. 4 million divided by 5. In the sense, 5 years, over 5 years, this could be used. The depreciation is 800,000. In the next year, what is the next year? 23-24. Depreciation base is the written down value, simply written down value, 4,000 minus 800, 3,200 is the written down value. This has to be depreciated over 4 years. Still, it is straight line, it is getting. This is next year, 24-25. You can complete this 25-26 and 26-27. You will be getting all these figures, depreciation as 800. Okay, we'll go to the next one. Say some activity. Toys manufacturing company acquired a machine to be used in the manufacturing process on 31st May 2023. What is the year of assessment? 23-24. 23-24. Cost is 2 million. The machine can be used for 5 years. On 10th April 2024, a major improvement was made to the machine. And for the purpose of taxation, 900,000 can be added to the asset. So this 900,000 entire amount could be added. Can be added. So that percentage computation, it has already been worked out. So this could be added to the asset. However, the remaining useful life remains at the same level, 5 years. We calculate the allowable depreciation and depreciation basis for year 24-25 and 25-26. So I have summarized the section on top for you to refer easily. Acquired a machine on 31st May 2023, that is in the year of assessment 2023-2024. Value is 2 million. 2 million divided by 400,000 is the depreciation. Depreciation base is 2,000. In the next year, that is 24-25, written down value is 2 million minus 400,600. How much can be add back? 900,000. So that particular percentage computation and limits, it has already been given, completed, let's assume. So this 900,000 entire thing could be added. 1,600 plus 900, we get 2,500. 2,500 divided by 4, we get 625. 625. In the next year also, you will be getting 2,500 is the value of this year, 2024-25 minus 625. You get depreciation base for the 25-26 years, 1,875. Divide that by 2, you get 625. In the sense, if you multiply 625 by 4, you will be getting 2,500. 625. If you multiply 625 by 4, you will be getting 2,500. What is this 2,500? So the remaining value of the asset after 23-24, and we added this 900, everything could be clear. This is just a verification. So we'll keep on going. In this situation, ABC company purchased a depreciable equipment at rupees 900,000. Depreciable equipment at rupees 900,000. The year is 14 June 2024. Useful life is 5 years. On 1st January 2025, 150,000 incurred for repair, not for an improvement. Remember, this is for repair. This is for repair. On 16th May 2025, 280,000 incurred on for an improvement. This is an improvement, not a repair, improvement. So this is improvement. So calculate the deductible amount of repair for year 2024-25. 24-25, how much can be deducted as repair? For 24-25. For the 24-25. For the year 24-25, this is the amount of repair that is incurred, so it could be deducted. Calculate the allowable depreciation for 24-25 and 25-26. So we'll keep on going. I have summarized the question here together with the answer. Equipment cost 900,000. Year is 24-25. 24-25. Cost is 900,000. This is an equipment. Therefore, lifetime is 5 years. Over 5 years, we have depreciate. 900,000 divided by 5, 108,000. See, the first question is calculate the deductible amount of repair for year 2025. This is the only amount. The only repair, it could be deducted. Depreciation for year 24-25. 24-25. This is the 24-25. 900,000 divided by 5, 180,000 is one answer. This is for 2020. 25-26. How do we work out? So there is an improvement. This improvement has been made in which year? In year 2025-26. Amount is 2. This is the amount. Amount is this much. Amount is 208,000. So how do we identify we get the written down value of the previous year. Previous year written down value is previous year, that is 2425. Written down value is 900,000 minus 900,000 minus this 180, we get 720,000. The limit is 720,000 into 20%, that is 144,000. This 144,000 can be deducted. This could be deducted. Remember, this could be deducted. Deducted as what? Deducted as an improvement. Deducted as an improvement. This could be deducted as an improvement. The rest, how much is the rest? 280,000. Out of this 280,000, we deducted 144,000 as an improvement during the year 2025-26. So the remaining amount 280 minus 144, 136. This 136 added to the depreciation base. Depreciation base is 720. The opening balance for this 136 is added. What is this 136? Out of this 280,000, some portion, that is 144, we have deducted as an improvement. The remaining balance is 136. So we add to the depreciation base. We get a value of 856. 856 has to be divided by 4 years. 4 years. We get depreciation as 240. 240. This is for year 2025-26. So 26, 27 also we get 240. Okay. And also you'll have to study the material, and when you come back to the class, we'll be doing a couple of activities with you. You are also given some work to be done at the class. Okay, next one. So next one, that depreciation working is over. Next one is business or investment losses. Business or investment losses. Say, if we conduct a business, if that this particular business has a profit, that is taxable. That is said to be a taxable profit. Business income is taxed. Similarly, when we work out the business profit, if we arrive at a loss, that loss could be deducted. That loss could be deducted. If this loss cannot be deducted in the current year, we can say, carry forward the loss for some other 6 years in order to claim. One other thing is, let's say we are a company, we have so many business. We have a bakery, we have a garment, we have a hotel. So 3 businesses. We have bakery, garment, and hotel. Some of the business, one business has loss, other 2 business have profits. The tax, I mean, all the things are tax adjusted. So we can set off our loss of a particular business from the profits of the other business. If everything can be claimed, so we claimed in the current year. If something cannot be claimed in the current year, after setting off, it could be carried forward to the next year. That is what this section refers. Say 2 types of losses may be incurred in the context of business or investment. Losses from realization of assets. Say we sell the assets. That is a realization. We transfer an asset. That is a realization. Or asset or liability of the business or investment. Total loss incurred on the business or investment. There are 2 types of. One thing is realization of assets and liabilities of the business or investment. The other one is something like net profit after the tax, before tax, net profit before tax. Total loss incurred on business or investment. Loss deduction rule. There is a rule I already told you. An unrelieved loss, unclaimed loss of the person for the year from a business can be deducted from any other business of that person. If a particular person has several businesses, all these businesses, some of the businesses could have profits, some of the businesses could have losses. So a person will have different financial statement, adjusted the profits of the finance statement as for the tax laws, and if there are losses, such loss could be set off against the profits. That is one possibility. The other one, the second one is unrelieved loss, unclaimed loss of a person for any of the previous 6 years of assessment can be deducted from the business or any other income. Let's say we are a business, we have a loss, we don't have any other business, so we have a tax adjusted loss, we can't claim current year, so we carry forward this for another 6 years. Carry forward the in the next year, if everything could be claimed, we claim. If everything cannot be claimed in the next year, 5 more years are remaining. This unrelieved loss is the unclaimed loss. Unclaimed loss means the amount of loss that has not been deducted in calculating a person's income. That is the meaning of unrelieved loss. A loss that has not been deducted. If a loss has not been claimed, and if we intend to carry forward that to the next years, that is the unrelieved loss or simply unclaimed loss. So that is the loss. The final one, trade debtor write-off expenses, trade debtor write-off. Say, if we conduct a business, we keep on selling goods on cash or credit basis. When we sell goods on credit basis, there are bad debts always. These bad debts. If a particular bad debts, all these bad debts should be trade bad debts. Trade bad debts. In the sense, let's say we are a manufacturing company, we give loans to our staff members for their personal matters. Some of the staff members, let's say they migrated without informing to us. They have taken some loans also. Those are not settled. But still, since we are a manufacturing company, we can't deduct such losses. Those are referred to as generally as staff loan. Loans given to the staff or employees. Those losses cannot be claimed. But the trade debts that becomes bad can be claimed. Trade debts that become bad can be claimed. A person other than person conducting banking business can claim write-off debt as bad debts. If such person has taken reasonable steps to recover and the person reasonably believe that the recovery is not possible. Let's say we are a manufacturing company, we have given a loan to a particular person or some other company. That some other company become bankrupt. The court declared that some other company is bankrupt, therefore they don't have any money. So we have evidence. If that is the case, we can claim such unclaimed trade debts as bad debts. Say, let's say we have given some, we have sold some goods on credit to a particular person. That particular person migrated without informing to us. That is our trade debts. So we have taken some reasonable steps. We have gone to the police, we have consulted a lawyer, we try to contact that particular person. If everything is not, okay, so we have taken some reasonable steps. Therefore, we can claim only the trade debts. The trade debts that becomes bad only claim. Other things cannot be claimed. Okay, so that is the end of the session. If we have any issues when we meet on physical basis, we can discuss these issues in the class on physical.